India's stock market is becoming the world's wildest casino, with more derivatives traded there than anywhere else in the world, and retail investors piling in at record speed. But what does this frenzy mean for traders of Indian stocks, and is this speculative energy about to spill over into crypto? Today, we're breaking down what's been going on with India's stock market frenzy and looking at whether crypto is next in line. My name is Guy, and you're watching The Coin Bureau. Firstly though, nothing in this video is financial advice. It's educational content that's meant to inform you about India's financial markets. And if this is the kind of content you want to get more of, then smash that like button, subscribe to the channel, and ping that notification bell. Now, for decades, India's stock market was seen as a club for the wealthy and well-connected, where old money families, giant brokerages, and blue-chip companies called the shots. Retail investing in India used to come with high hurdles, endless paperwork, minimum balance requirements, and a system that worked best if you already had a foot in the door. The little guy rarely got a look in, and for most Indians, savings meant gold, real estate, or simply cash under the mattress. But all that started to change after 2016, when India's government basically cancelled most of the country's cash, forcing millions of people to open bank accounts and use digital payments for the first time. Soon after, the Aadhaar digital ID system, already in place, became the backbone for instant eKYC and digital onboarding. From that point on, anyone could open a brokerage account from their phone in minutes, and stock trading became as simple as downloading an app. Fast forward to 2025, the National Stock Exchange, or NSE, now boasts over 230 million investor accounts, with retail investors owning nearly 18% of NSE-listed companies' market cap, up from around 11% in 2014. Now, while this 18% figure might not sound impressive, especially compared to the US, where retail investors control over half of the stock market, it's important to remember that India's markets are much younger. The real story is the speed at which Indian retail investor participation is rising. The bulk of these new traders are young, with the median age at just 32 and close to 40% of retail investors being under 30. And as in the rest of the world, this is a generation raised on smartphones and social media, hungry for higher returns. But derivatives are where things get really interesting. For every dollar traded on spot markets, more than $400 moves through derivatives markets. By 2024, India accounted for 89% of all global equity options volume, more than the US and indeed more than any other market on Earth. In fact, on some days, India's options market is 300 times larger than the stock market itself, with retail investors driving about 35% of all trades. The real driver behind this risk-taking isn't just technology, however. It's also culture. Years of low returns on savings, high youth unemployment, and the general excitement of risk have created a generation that treats trading less like investing and more like a sport. Mobile apps, discount brokerages, and influencer culture amplify the FOMO. YouTube, Telegram, and WhatsApp are packed with gurus promising easy riches through all-or-nothing options trades. And it's not just retail. Foreign investors are still a major force, holding around 16% of India's listed company value as of August 2025. That share has dipped recently, though, thanks in part to the ongoing tariff saga, which, by the way, we broke down in detail right over here. Now, all this activity has helped push India's stock market into stretched valuation territory. At the time of recording this video, the Nifty 50, an Indian stock index, trades at around 22 times earnings, which is elevated by any standard, though not quite the record 37 times we saw during the pandemic. Still, India remains one of the world's most expensive markets. Additionally, India's total market value is now hovering around 140% of GDP, well above its historical average. And while a sharp correction earlier this year erased over $1 trillion in market capitalization, new account sign-ups barely slowed, and markets are back near all-time highs. Now, with speculation running rampant, it's no surprise that global players also want a slice of the action. And in India, no story made bigger waves this year than that of Jane Street. Jane Street isn't a household name in India, but it's nevertheless one of the most profitable trading firms on Wall Street. Their speciality is high-frequency, algorithm-driven trading that thrives on speed, volume, and unusual market quirks. And when Jane Street set its sights on India, they found the local market structure to be a goldmine. By 2024, the notional value of index options traded on the NSE had soared past $900 trillion, more than double the previous year. On expiry days, volumes would explode, fueled by millions of retail traders and many using high leverage with little experience. This is where Jane Street came in. They allegedly employed a two-phase trading strategy on expiry days. In the morning, they aggressively bought up major Indian banking stocks, accounting for up to 25% of the volume in some names. This pushed the index higher and made put options, essentially bets that the market will fall, much cheaper. Then, in the afternoon, Jane Street reversed course, selling the stocks and triggering a sharp drop in the index, just as the put options they'd quietly acquired skyrocketed in value. On a single day in January 2024, they allegedly pulled off this strategy to the tune of $86 million in profit. Altogether, it netted Jane Street an estimated $4.3 billion in profits from January 2023 to March 2025. But this success didn't go unnoticed. In July 2025, the Securities and Exchange Board of India, or SEBI, accused Jane Street of, quote, intraday index manipulation. Regulators argued that these trades, which seemed to have no rational basis other than to manipulate expiry prices, broke the rules and gave SEBI a chance to flex its muscles after criticism for past inaction. SEBI therefore responded by freezing Jane Street's Indian accounts and ordering $566 million in alleged illegal profits into escrow. Jane Street, for its part, continues to deny any wrongdoing, insisting these were standard arbitrage trades, legal, common, and even beneficial for market efficiency. But the story didn't end there. After a period of suspension and legal wrangling, SEBI lifted the ban, allowing Jane Street to resume trading in India, this time under much stricter oversight and with an ongoing investigation hanging over the firm. But, in other words, Jane Street is now back in the game.
Apologies for the interruption, folks, but I very quickly want to tell you about the Coin Bureau deals page. Now, if you're interested in things like discounts on hardware wallets, money off trading fees, and exchange sign-up bonuses, then the Coin Bureau deals page is absolutely the place that you need to check out. The link is in the description below. These are some of the best deals and promos in all of crypto, so check it out when you have a moment. Okay, enough from me, back to the video.
Now, while the Jane Street drama grabbed headlines, the bigger story is what's happening to India's millions of everyday investors, the place where this casino truly reveals its cost. The numbers are simply brutal. According to SEBI, more than 90% of retail futures and options traders lost money last year, with combined losses totaling about $12.5 billion, a 41% jump from the year before. The average losing trader was down roughly $1,300, which might not sound like much in US terms, but in India, 3/4 of retail traders earn less than $6,000 a year. For many, a single bad trade can wipe out months or even years of savings. Despite these odds, though, the trading boom rolls on. Social media, so-called finfluencers, and course sellers flood feeds with promises of easy riches, luxury lifestyles, and secret systems. But the reality is that most of these schemes make their money from referral commissions and subscriptions, not actual trading. The occasional rags to riches story is the exception, and it usually starts with a hefty bankroll anyway. The whole thing feels more like a meme coin craze than a traditional stock market. Pump and dump schemes in small and mid-cap stocks, insider trading in companies with weak oversight, and front-running by brokers are all far too common. Even so-called algo trading, pitched to retail investors, is often just a churn machine for commissions. Real, profitable high-frequency trading requires serious tech and capital, something the average trader doesn't have access to. So, why do so many keep coming back? Well, for a lot of people, it's not just greed, it's hope or even desperation. Good jobs are scarce, living costs keep rising, and the dream of a life-changing win is hard to resist, especially when winning is being marketed so aggressively on social media. And regulators are clearly struggling to keep up. SEBI has cracked down with bigger minimum trade sizes, better risk disclosures, and proposals to ban weekly options. But with such a massive and fast-growing trader base, it's an uphill battle. India therefore faces a real dilemma. It wants to deepen its capital markets and bring in more participants, but it also needs to protect small investors from being wiped out. The cost of turning every smartphone into a trading terminal keeps rising, and with every new wave of losses or scams, the pressure for tighter oversight only grows. But if there's one market where speculation runs even hotter, it's crypto. So, how are Indian investors handling the world of digital assets? As of 2024, India topped Chainalysis's Global Crypto Adoption Index with more than 115 million estimated users and nearly $143 billion in crypto value received in the prior year, second only to Indonesia for total value received. And it's not just a retail story. Large professional transfers are a growing share of the action. But while adoption is booming, policy is far from friendly. India's tax regime for crypto is among the world's harshest. Since 2022, crypto gains have been taxed at a flat 30%, with a 1% tax deducted at source, or TDS, that applies to nearly every transaction over $115. Add an 18% goods and services tax on trading fees, and crypto trading in India is among the most expensive anywhere. India's 2025 union budget, that is the country's annual federal budget, kept all these tax rules in place and for the first time requires every crypto trader to file a detailed Schedule VDA reporting every single transaction to the tax authorities. But wait, there's more. Any unreported crypto income discovered during a tax investigation can be taxed at 60%, plus penalties of up to 200% of the tax owed, and even possible prison time. There's also no distinction between short-term and long-term gains, unlike with stocks, and losses can't be used to offset any other gains. This puts India at the top end globally for crypto taxation, right alongside Japan and Belgium. For domestic crypto exchanges, the effect has been devastating. Trading volumes on Indian platforms have dropped by as much as 70% since the 1% TDS was introduced, with users and trading activity fleeing to international exchanges in Dubai, Singapore, and elsewhere. Studies estimate that more than 5 million Indian users moved to offshore platforms in the year following the TDS rollout. Even when regulators tried to block offshore exchanges in late 2023, users simply switched to new apps or VPNs. In fact, despite the ban, nearly 40% of all centralized crypto trading in India in 2024 still took place on platforms like Binance and KuCoin. Recognizing the limits of the crackdown, Indian authorities later negotiated fines and set new compliance requirements. As a result, some of these previously banned exchanges were allowed to reopen, though the regulatory climate remains chilly and uncertain. Even with these hurdles, though, crypto adoption in India keeps rising. The country's youth and tech talent are leading the way in Web3 developer activity, contributing nearly 12% of global open-source crypto development in 2024, second only to the US. But for every coder and trader, there's an ongoing tug-of-war between innovation and regulation. Then there's also the policy debate. The Indian Supreme Court has urged the government to move beyond just taxing crypto to actually regulate it. Industry groups are proposing big changes, like the 2025 Coins Act, which calls for a dedicated crypto regulator, fairer taxes, and digital rights like self-custody. And while there's cautious hope that international consensus could soften India's stance, for now, crypto sits in a regulatory grey zone and is likely to remain there for the time being. So this brings us to the big question. With India's stock market feeling more like a high-stakes casino than ever, could that same speculative energy flood into crypto? Or will the barriers keep most would-be traders out? Well, the potential is obvious. India's retail traders are young, tech-savvy, and comfortable with risk. Many investors are now eyeing crypto as an alternative, not necessarily out of loyalty to the technology, but because traditional markets increasingly feel like a game of chance. But while the appetite is there, the hurdles are real. Crypto trading in India is far more costly than stocks, with no relief for losses or long-term holding periods. The entire system is designed to collect tax and discourage speculation, not to foster innovation or encourage trading. Regulatory uncertainty only adds to the caution. Yes, crypto is legal to own and trade, but the rules can change at any time. It's also reminiscent of the SEC's past unpredictability in the US, except in India there are consequences for retail traders and bad actors alike. There's also a bigger force at play. India's digital rupee. The Indian Central Bank's CBDC is already used by over 5 million people, and unlike many other countries' attempts to push CBDCs, in India, digital rupee adoption actually seems to be working. Policymakers pitch it as a safer, more controllable alternative to crypto, one they can monitor, regulate, and steer. Bybit even added support for the digital rupee in 2024, which shows there's genuine demand beyond government propaganda. But again, could India's market mania spill into crypto? Well, the answer honestly isn't clear. On one hand, crypto's promise of outsized returns and financial freedom has massive appeal, especially to young Indians. On the other hand, though, high taxes, constant compliance checks, and the risk of sudden clampdowns make it a minefield. Many traders have already shifted to offshore exchanges, but that brings new risks like scams, frauds, and headaches repatriating profits. At the institutional level, meanwhile, there is growing curiosity, but with no regulated vehicles like Indian Bitcoin ETFs and a murky regulatory environment, most of the big money is still staying on the sidelines. That said, though, as we've seen in the US, things can change quickly. India may not have an imminent national election to spark a policy shift, yet as global crypto regulations evolve and trading volumes increasingly move to Dubai, Singapore, the US, and elsewhere, pressure for change at home is mounting. So, while a crypto retail frenzy in India may not happen overnight, there's clear demand and an eager user base ready for the country to become a global powerhouse in digital assets. Let's just hope that if it happens, it's under real regulatory clarity, so India builds a mature, resilient market instead of just another meme coin casino. And speaking of meme coins, if you want to find out more about that mad section of the crypto market, then check out our in-depth guide right over here. And if you haven't subscribed to the channel yet, you can do so right over here. Okay, thank you all so much for watching, and I'll see you again very soon. This is Guy, signing off.